Hello everyone, welcome back to Upside Down Data. Today I want to talk about some macro factors that might be worth watching to speculate about where crypto and Bitcoin might be going from here. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter, where we put out regular updates about our risk indicators and more. So I'm sure this is nothing new to say that what a lot of people have been saying, what I also personally believe is the case, that for the most part, this fall off of the highs in November, so we're looking at the Bitcoin chart here, fall off in November has been largely driven by macro factors, inflation, and the Fed's battle against inflation as they've been tightening monetary policy and raising interest rates. And so obviously with the more recent meltdown, there was the whole debacle with Luna and UST, which is kind of an intra-crypto space, but I think it's also very reasonable to argue that what made that a possible thing to happen in some ways was the fact that the crypto market's been correcting so heavily that so much liquidity has been pulled out of the markets. So I think what everyone's then asking is, okay, if macro factors are driving the bus, when might we expect some relief from those macro factors, right? When can we expect the stock market to start doing better? Stock market and crypto are heavily correlated right now, so if the stock market starts doing better, crypto will do better as well. Maybe one of the more pressing things that people are watching is when will the Fed take the gas off of their interest rate hikes? That's one thing that is widely believed, that once that might stop or reverse, that is the kind of condition that crypto likes, that crypto can then start making moves, appreciable moves, noticeable moves back to the upside. So obviously it's really hard to know. There's many different factors that go into it. But one of the indicators that I like to follow, or just one of the data points I like to look at when considering the what the Fed might do in terms of their interest rates, is actually the 2-year government bond yields. And why do I say this is important? Why do I think this is useful? Well, if we just overlay the federal funds rate on top of the 2-year Treasury bond yields throughout its history, so starting back in the late 80s here. This is the weekly chart I'm showing you. What you can see is that bond yields tend to lead what the Fed does with their interest rates, right? You see the bond yields moving up sooner than the actual rate hikes go up, and then start falling they peak before interest rates start falling. So you see it again, rising up, it lines up against each other, start rising up ahead, and then falling down before, peaking before, peaking before. It's a recurring pattern where the Fed with their interest rate hikes tend to follow what the 2-year bond yields are doing. Now, obviously, it's hard to know if there's any causal relation here. But one thing that's very plausible is just simply that the bond market is quite good at being able to anticipate what the Fed is likely to do in the future. With the Fed and what they're ending up doing, it's not a black swan event when they raise the interest rates, right? It's very much telegraphed. It's a lot of discussion. The idea being that a market where people have their money on the line might actually be able to preempt some of those moves, start sniffing it out ahead of time. I mean, arguably, that's exactly what happened in the crypto market. People sniffed out how big of a problem inflation would be back here, and were selling off before it really became into the common consensus that that was the case. And so that could be an argument for why the 2-year Treasury yield is able to kind of identify what the Fed might be likely to do. Because obviously, short-term Treasury yields are very heavily affected by what the Fed, the federal funds interest rate is. So that's interesting, right? And so what we might be hoping for then, right now, I'm going to take the funds away. I'm going to switch over to the daily chart. What we might be hoping for then, if that's actually the case, that the 2-year Treasury yield bonds tend to lead what the Fed does in terms of their interest rates, we might hope for this to start curling back down. Because again, every single time this has rolled over, that this has peaked and moved back down, just looking at a recent example, not too far into the future, the Fed has capped their rate hikes, either gone steady, and then actually will then reverse it. And we can go back here as well to see the same thing, where the 2-year Treasury yields peaks before the Fed starts moving back down. And usually by the time it's peaked and moved back down, the Fed starts plateauing. They don't continue to raise interest rates. And one of the things that I've just been looking at personally as I've been watching the 2-year Treasury yields is just what the RSI has been doing for it. And what you can actually notice is that a bearish divergence has actually been forming on the daily, we can see that overall, the trend had been up in terms of the yields, but the trend on the RSI has been down. And so that would be a bearish divergence. Now, obviously, you can get these bearish divergence forming, like we could say that happened here, bearish divergence forming here to some degree between these peaks, and then break up through it. And so what we might actually want to see is the RSI continue in a downtrend, right? If we draw a trend line of these peaks here, so let me just make this a little bit more easy to see here. We just draw a trend line across these peaks, we might hope to see the RSI not be able to break above that trend line again, kind of continue moving down. That might then mean that a rollover is possible on the 2-year Treasury yields, which is exactly what we would like to see. And we can actually go back just and look at the last time we had a rollover on the 2-year yields, and again you see this kind of bearish divergence where there's this peak up at around here and then rolling down. So even with the actual high setting in a lower high than back here, and then down we went. We'd like to see a similar thing play out here again if we want to see the Fed take their foot off the gas. Now, obviously, one could argue about whether or not it's, in the long term, a good thing for the Fed to take their foot off the gas, while inflation's so high. I think that's a completely different story, obviously. But if we're just talking about in the short term, what would be good for crypto, to the degree that raising interest rates has been bad for crypto and that reversing it might be good, you might actually see that. Because again, what the Fed stopping their rate hikes and actually capitulating and going back down might mean that they're not really going to be that serious about raising inflation. And that's where hard assets like gold or hopefully crypto become more desirable. People wanting to kind of hedge. They don't want to be in dollars because dollars are just going crazy inflating. They'd want to get into a harder asset that might hold its value better. And so that's where crypto maybe would be able to shine to some degree. And even the stock market could do better in that kind of environment where people want to have just some kind of asset to hold on to. And so stocks can be another place to go to try to, hedge against that inflation that will just be inflating the dollar away. Now let's talk also about the stock markets. This is the S&P 500. Now, one of the things that's important to note is just looking at the kind of the volume profile, the volume that's been transacted in this recent time here. You can see it's very much heavy towards the top end of this range, right? Well above where we are right now. And what that can often mean is that there's some technical resistance that we might hit as we go back up. So let's say that there is something that's bullish catalyst that starts pushing us back up. This just might mean that there might be some people looking for the exits, especially if we haven't seen some of those conditions change where, for example, the Fed has reversed course on raising interest rates. If that hasn't changed, there might be a lot of people looking to exit, recoup their cost basis from up here. Now, it is important to note, though, that this isn't a doomsday scenario by any means, that if there are bullish catalysts, we can slice right through those kind of resistance zones, and nowhere else do we have to look than the situation leading up to the March 2020 crash, right? If we look at this, the majority of the volume was well above where we bottomed out here, but because central banks pivoted and were so clearly telegraphing that they were going to essentially bail the markets out, we just sliced up through it. That might be a similar thing that could happen again, if the Fed becomes more dovish all of a sudden, that the stock market would then see that as a green light to start rallying again. And especially if people are looking at stocks as being one way of potentially hedging against inflation if the Fed is just going to decide to let that run wild. And one of the things people talk about is, the Fed is going to have to make a choice between, at some point they might have to make a choice between raising rates and causing a recession. And so it'd just be a question of which side they would end up going to if it came to that point. Would they just go ahead and let the recession happen, which Jerome Powell, I think, wants people to believe that he's willing and ready to do, or would they capitulate and start going back to quantitative easing, even if inflation was relatively high? So those are just some things to look at. Obviously, I'm not a macroeconomist, so I'm not looking at the full picture. It's obviously, all this is way more complicated than just that. But just some things that I'm personally watching to kind of speculate. And just the fact that the federal funds rate and the 2-year yield tend to go together so much, and that the 2-year yield tends to lead federal funds rate often, it would be, a hopeful sign from the perspective of hoping the Fed takes their foot off the gas or pumps the brakes on the rate hikes to see this roll over. Obviously, still a question of whether or not it's actually good overall for the economy. Okay, so the last thing I want to talk about today is just to look at some on-chain metrics for Bitcoin, just being another macro consideration. I view, obviously, like a lot of people, on-chain to be more of a macro kind of thing. And what I want to look at is spending behavior, and specifically who is doing the spending recently. So what we're looking at in this chart is the long-term holders and short-term holders realized price shifts in the last 30 days. And essentially what that means is for coins that have been moving on chain, are they coins that are in short-term holder hands, or were they in long-term holder hands? And then where were they moving from and where are they moving to? So the way we can read this chart is that these dark red bars are new short-term supply. So this is an increase in short-term supply. Dark blue bars are increases in long-term supply. Essentially, what this is just meaning is that things that used to be short-term supply have aged into being long-term supply, which is around 155 days. That's what that means there. And then these dotted pink lines here, or dotted red lines, this is where the short-term coins moved from. So they moved from these levels down to these levels. And then likewise, these dotted blue bars here is long-term holder coins moving from this level into what would be short-term holder hands. Because again, any new coin, any new cost basis will be considered a short-term holder supply, basically. So this is a very useful chart because it can tell us who is selling and where they were selling from in terms of price. So the x-axis here is price of Bitcoin. What we can see is that the vast majority of selling that's been happening in the past month, including the big capitulation that we saw, over the last week or so, is from short-term holders. The vast majority has been selling from, the 50K range, some from the high 50Ks, a lot of it from the 40Ks down to, basically the 40Ks up to the low 50Ks, with a little bit above. That's where the majority of the selling has been happening. The people capitulating, the people contributing to this massive volume spike that we've seen down here, by and large, have been short-term holders from this range, most likely based on on-chain activity. We really haven't been seeing a ton of long-term holder supply move. We have seen some. Some people have been capitulating who had bought in, back in the summer, so back in this range, ended up selling out into this weakness over here. That's what these people are back here. We've seen some of the people all the way back from over here selling. That's what these people are here. And then some people from way long ago. So people back when Bitcoin was at 11K, 10K, all the way down to 4K, they've been selling. But you can just see that the magnitude is so much smaller in the long-term holder hands than the long-term. It's still the case that most of these capitulations are being driven by the people who had accumulated back in this zone over here. Really kind of this range here, maybe going back to this range here, are the ones who are responsible for a lot of the selling that we saw over here based on this chart. And I think that that's hopeful, right? Because what we don't want to see is long-term holders capitulating, because when that happens, that tends to be when you get the major capitulations down to extreme bottoming out points. And if we look at the long-term holders' average realized price, which is basically their average cost basis, we can really see this happening, that every big macro bottom that we put in, really ever since 2012, has been below the long-term holder realized price, their average cost basis. You can see that in 2012, we dipped below. Back here in 2015, dipped below. 2018, dipped below. And that's what I think a lot of people are looking at. Will we dip below again as well? Wouldn't have to, right? Certainly wouldn't have to. I think it's a bit of a folly to think that because it's happened every time in the past, it happens to happen again. That just because we've done this every other bear market bottom, that we have to do that again for this bear market bottom. But we certainly could. And the closer the price gets to this level, probably the more likely we are to start seeing long-term holders capitulate and drive the price down below this level. The more likely we are to see people start selling out from probably even these lower levels. And the reason, we've talked about this before multiple times, is that cost bases are most important when the price is near your cost basis. This is prospect theory, that you experience psychologically losses and gains more heavily, more quickly, the closer they are to zero, to your cost basis. So as price gets closer and closer to, in this case, 19K, the more likely we are to start seeing long-term holders start capitulate, because they're going to start feeling that loss a lot more acutely, that loss of gain a lot more acutely, and they're certainly not going to want to see themselves get into loss. Now, obviously, the more optimistic framing of this is that they might just step in to buy more as we get closer to their cost basis to come in on the defense. But if we were to get to this situation, especially if we slice below, there could be quite a bit of selling that really drives us down into that bottom. You'll see that usually, really 2012 being the exception, usually it's been the case that once we cross that line, there's been more downside that's followed. Again, wouldn't have to happen. You know, you could argue that in the COVID crash, March 2020 crash, it was really the long-term holder cost basis that acted as support that drove us back up. So that would be a thing. And especially if we were to come back to this level and there would be some other bullish happening, like let's say the Fed, you know, stopping, going back to quantitative easing, for example, that might be where long-term holders are more likely to come in on defense rather than capitulate out. We'd really have to wait and see what happens when we get there. But again, the closer price gets, the more concerning that's going to be. So that's another thing to be watching, is what are long-term holders doing? Are they starting to really capitulate? Are the bars starting to rise up? Is there more long-term selling in proportion to short-term selling? If that starts happening, then watch out below, because we could start really diving down. If that doesn't happen, long-term holders stay relatively sticky with their coins. They don't really want to spend them. They don't want to sell them. That might offer some cushion and might suggest that we're just going to have to wait until short-term holders get exhausted in their selling before we can start going back up. Time will tell. So those are some things that I'm watching, just so I wanted to talk about in the macro picture. That there's at least one thing that I'm watching that, again, obviously what the Fed does with their interest rates is a lot more complicated than just what bond yields are doing. But again, to the degree that markets tend to be forward-looking and kind of can predict maybe what the Fed's doing, this might give us some signal if we see this start to roll back over. The stock market's able to rally back through that resistance that might be built up here. That would be a bullish effect. And if long-term holders can continue holding their coins, that could offer a buffer. But obviously, make no mistake, we don't get a rollover here if we see this continue to go up, and then regardless of what this does, if the Fed just keeps on tightening, if the stock market keeps crashing, I personally do not see this as by any means safe as being the bottom, and we could have more pain to come. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. Put a lot of updates about indicators and more over there.